today. The first cryptocurrency, Bitcoin, started something as profoundly transformational as the internet. At the same time, a currency and a payment system, a digital representation of value with its own built-in value transfer system, and a form of digital cash that behaves a little like a commodity. This experiment in democratized money has produced an underlying technology that you've heard of already, blockchain, that delivers trust in an otherwise trustless realm. It has the ability to provide an incontrovertible single source of truth that cannot be altered or corrupted. The potential of this trust mechanism has not been missed by the public sector and private sector. In government, finance, pharmaceuticals, media, arts, charities, and hundreds more sectors, businesses are looking at ways blockchain or distributed ledger technology can drive efficiencies, create value, and build growth. Even regulators are looking at distributed ledger technologies as a way to improve their effectiveness. Contrary to popular belief, the attribute enabling much of this technology is transparency. Ledger entries are present for every participant to see, and trust is therefore achieved through a combination of openness and cryptography. The perception that cryptocurrencies are anonymous is largely myth. The reality is they are pseudo-anonymous, not actually anonymous, but having the appearance of being so. The corollary, that cryptocurrencies are mainly used to launder money, is grossly overstated and unsubstantiated. The ability to trace past transactions render virtual currencies highly unsuitable for money laundering. The best estimates of global money laundering, according to UNODC and the Financial Action Task Force, are around $1.6 trillion, or 2.7% of global GDP in 2009. Compare this figure with the total dollar value of cryptocurrencies at around $7 billion. The largest cryptocurrency, Bitcoin, accounts for over 90% of all the cryptocurrencies today, and detailed analysis of its blockchain, something made possible by its inherent transparency, allows us to deduce that virtual currencies account for something considerably less than 100,000th of 1% of global money laundering. According to a recent Europol report, 500 euro notes account for 30% of the 1 trillion euros banknotes in circulation, despite not being a common means of payment. It would not take too much to conclude that the euro is at least 92 times more likely to be used in money laundering than virtual currencies. Now, the UK has perhaps undertaken the most work within the EU to gather evidence of the use of virtual currencies in money laundering. Its National Risk Assessment of Money Laundering and Terrorist Financing, published in October last year, placed virtual currencies at the bottom of a list of 12 thematic risk areas. Banks, of course, came at the top of the list with a risk rating 14 times worse than that of virtual currencies. And it concluded that the money laundering issues concerning digital currencies are similar to the issues identified with many other financial instruments, such as cash and e-money, and that digital currencies are currently not a method by which terrorists seem to raise or move money. Now, as the number of use cases for distributed ledger technology grow daily, they include a broad range of financial services, through collateral management, reference data, micropayments, trade credit, supply chains, identity, KYC, aid disbursement, being just a few. Over 40 global banks recently joined together in one consortium alone. And central banks, including the ECB, the Bank of England, and the Fed, are investigating the potential use of distributed ledger technology to provide digital fiat currency. In a 40-page IMF discussion note on virtual currencies published last week, its authors concluded, new technologies are driving transformational change in the global economy, including in how goods, services, and assets are exchanged. An important development in this process has been the emergence of virtual currencies, which offer many potential benefits, including greater speed and efficiency, and ultimately promoting financial inclusion. Distributed ledger technology offers potential benefits that go far beyond virtual currencies themselves. And if I may just briefly enumerate my 4 suggestions. In ECON's careful deliberation on virtual currencies, I would respectfully urge you to understand that they are still in the experimental stage, to recognise that the value of virtual currencies is still tiny compared with money supply, and to follow the ECB's recommendation in its second report on virtual currencies that there is no need to amend or expand current EU legal framework on virtual currencies. But if you are minded to propose legislative action, to limit such action to anti-money laundering and countering terrorist financing by following FATF's recommendation to target the gateways between virtual currencies and the regulated financial system, and not regulate users who obtain virtual currencies to purchase goods or services. And finally, to encourage and support the development of this innovative, transformational technology within Europe's digital agenda, allowing the Internet of Trust to flourish and bring positive improvement to Europe's economy and its citizens.